Guys, in this video we are going to learn how to prepare the income statement based on the marginal costing method and absorption costing method. I took the HNDA Pastpaper 2019 fourth year second semester as a example question. There's a questions number 3 and part 3. Question is the cost details of ABC PLC are given below. Selling price rupees 7 per unit, variable cost rupees 4 per unit, fixed cost rupees 1.5 per unit, normal production 20,000 unit, total fixed cost for the year 30,000. Following statement shows the position of opening and closing stock. For the year 1, there are no any opening stock. Production 22,000, sales 18,000, closing stock 4,000. For year 2, the opening stock 4,000, production 18,000, sales 16,000, closing stock 6,000. You are required to prepare the income statement under the marginal costing and absorption costing method. Second one, we need to prepare the profit reconciliation statement. So let's calculate the income statement. Before doing the income statement, we need to know what is the difference between marginal costing method and absorption costing method. When we prepare the marginal costing income statement, we should consider the variable cost for production cost. And when we prepare the absorption costing method income statement, we should prepare the full cost. That means variable cost plus fixed cost. So we need to consider the full cost for absorption costing method. So let's calculate. For year 1, we start with the sales. As per the question paper, there's a 18,000 selling unit and per unit 7 rupees. So 18,000 into 7, 126,000 total sales. 126,000 total sales. 18,000 into 7. Right. Then we need to calculate the production cost. First, opening stock and production. Then minus closing stock. There are no any opening stock unit and production unit as per the question paper 22,000. So production unit 22,000 and closing stock 4,000 unit. So we are calculating the income statement based on the marginal costing. As I said earlier, we should consider only variable cost. So in question paper, they gave the variable cost per unit 4 rupees. So we should multiply by 4 rupees. So opening stock 0 and 22,000 into 4, 88,000 minus 4,000 into 4, 16,000. So total production cost 88,000 minus 16,000, 72,000. So when we deduct the 72,000 from sales, it's called as a contribution. 126,000 minus 72. 54,000 contribution. Then we need to deduct the fixed cost. Total fixed cost 30,000. So 24,000 is net profit. Right? Then we can calculate for year 2. Sales. Total sales as per the question paper. Sales unit 16,000. So sales 16,000 into 7. Total 112,000. And we need to calculate the production cost. Opening stock, production unit, then minus closing stock. So opening stock 4,000 and production 18,000 and closing stock 6,000. Right? We are doing the income statement based on the marginal costing method. So we should consider the variable cost only. So variable cost per unit 4 rupees. So unit into 4 rupees. Opening stock 16,000. Production 18,000 into 4. 72,000. Minus 6 into 4. Sorry, 6,000 into 4. 24,000. So total production cost 64,000. So 64,000 should be deduct from sales. 112,000 minus 64,000. 112,000 minus 64,000. It should be 48,000 contribution. Why we are calling this amount 48,000 as a contribution? Because the contribution is sales minus variable cost. So consider the opening stock, production unit and closing stock based on the marginal costing method. So we consider only the variable cost. So sales minus variable cost, it's called as a contribution. So don't confuse on this amount 48,000 as a contribution. It should be a contribution because sales minus variable cost. Then we need to deduct the fixed cost. Fixed cost is 30,000 as per the question paper. So net profit is 18,000. Right. So year 1 the net profit is 24,000 and year 2 18,000. Then let's calculate the profit statement or income statement based on the absorption costing method. When we prepare the absorption costing income statement, we should consider the full cost as a production cost. So we can prepare sales. First year sales for the first year, 18,000 into 7, 126,000 total sales. Then we can calculate the production cost. First opening stock and production unit, then minus closing stock. So there's no any opening stock in year 1, and production unit for year 1 22,000 and closing stock for year 1 4,000 into, we need to multiply by full cost. As per the question paper, the variable cost 4 rupees and fixed cost per unit 1.5 for total 5.5. So total cost for the production unit 22,000 into 5.5 is 121,000. 121,000. Opening stock 0 and 4,000 into 5.5, 22,000. So production cost 99,000. So 99,000 should be deduct from sales. 126 minus 99,000. 126 minus 99,000 is 27,000 gross profit. Right. Then we need to adjust the over absorption and under absorption. What is the meaning of over absorption and under absorption? In the production company, there's a normal production unit. When we use the resources and efficiency level as normal, how many unit we can produce, that is called as a normal production unit. So normal production unit, as per the question paper, the normal production unit is 20,000. Everyone know the fixed cost never change until certain period. So fixed cost, total fixed cost 20,000 into 1.5 is a 30,000 total fixed cost. But in this scenario, we produce 22,000. 22,000. As per the question paper, the production unit is 22,000. So we multiply in the income statement 22,000 into 5.5. 5.5 including 1.5 fixed cost. So we calculate 2,000 unit additional unit fixed cost. So we need to adjust that because fixed cost never change in certain period. So we can't calculate more, we can't include more over the 30,000. So the production is 22,000, normal production is 20,000, so overproduction 2,000. So 2,000 into 1.5, 2,000 into 1.5 is over absorption. So 2,000 into 1.5 is 3000 is over absorption. So it should be add with profit as the over absorption. Over absorption 3000. So net profit is 30,000. Right. Then we can calculate the profit statement for year 2. For year 2, the sales is 16,000 into 7. Into 7. So total sales 112,000. And we need to calculate the production cost. Opening stock, production unit, and closing stock. Opening stock 4,000 unit and production 18,000 unit and closing stock 6,000 unit. Right? We are preparing the income statement based on the absorption costing method. So we should consider the full cost. So full cost is 5.5. So the opening stock value is 4,000 into 5.5. 22,000. And production cost 18,000 into 5.5. 99,000. And closing stock 6,000 into 5.5. 33,000. So total production cost 121 minus 33 is 88,000. So 88,000 should be deduct from sales. It's called as a gross profit. $112,000 minus 88,000, 24,000. And we need to adjust over absorption or under absorption. In this year 2, the total production is 18,000. Total production 18,000. And normal production level 20,000. So 2,000 unit is under production. So 2,000 into 1.5 is under absorption. So it's equal to 3,000. 3,000 is under absorption. So we need to deduct from the gross profit under absorption. So net profit 21,000. Right? So this is the answer for these questions, calculate the income statement based on the marginal costing and absorption costing. When we prepare the marginal costing and absorption costing method income statement, we should remember that when we prepare the marginal costing, we should consider the variable cost only. When we prepare the absorption costing method, we should consider the full cost, variable cost plus fixed cost. I hope this is clear for everyone. If you have any doubt, please mention the comments. I will rectify as soon as possible. Thank you.